Welcome back. We're now going to be covering the third part of our property, plant and equipment pre-recording lectures. The third part is going to be covering the subsequent measurements. So we're still looking at property, plant and equipment. It's IAS 16, chapter 5 of our prescribed book, and we are doing week 2 material. As a mind map to see where we're at, we have already identified that the item is property, plant, and equipment. We've decided that we can recognize this item as property, plant, and equipment. We have performed the initial measurement, so we have recorded this item at its cost in connection to the IAS 16 principles. And we are now going to be applying subsequent measurement principles to this item. So in terms of our study objectives, we are looking at the measurement after recognition, and we are going to be looking at concepts of depreciation, revaluation versus cost model, and impairment. Okay, before dwelling into those 3 subsequent measurement principles, it needs to be acknowledged that with respect to an item of property, plant, and equipment, further expenditure will be incurred on the item. So what we're meaning here, for instance, is if we've got a vehicle, we purchase a vehicle, we have to run it, so we have to pay for things like petrol, we have to service it, we perhaps have to replace major things like tires, we have to replace sometimes major parts after a while, such as our engines. And all of those types of activities require expenditure after the fact that we have purchased the item. This is what we refer to as subsequent expenditure. So all those types of expenditure, we need to have a look at the principle of the expenditure and see whether it counts as being able to be added to the cost of the asset, or whether it would then be expensed. So the principle in terms of subsequent expenditure is that it may be added to the carrying amount of property, plant, and equipment. So this is when we've actually spent this money. We can then add it to the carrying amount of property, plant, and equipment if that recognition criteria from property, plant, and equipment that we looked at in part 1 is met, which is that it's probable that future economic benefits associated with that particular expenditure will flow to the entity. So it's not the item that you are expending the amount on, it's with regards to that particular expenditure, and that we can measure that expenditure cost reliably. So IAS 16 paragraph 12 and paragraph 13 then also give some more insights into subsequent expenditure and types of subsequent expenditure. One type of subsequent expenditure, as mentioned in paragraph 12, are our day-to-day servicing costs. So going back to the fact that we have a vehicle, once we've purchased the vehicle, we will have to service this item from time to time. So generally, when you purchase a vehicle, you go in and they would give you a little book to say this is the service book, and they tell you either service it every 15,000 kilometers. Alternatively, you should bring the car in every year for a service, and then they will do the relevant things that need to be done with respect to that service. And then there's a specific format that they will then have a look with regards to that service. So your first service, for instance, would be changing of oil filters, maybe some air filters, and doing some minor little things. And as you've traveled in the vehicle for longer, those sorts of services sometimes become major services where you have to replace things such as cam belts. Yeah, so that is what we refer to as day-to-day servicing costs, the expected servicing costs that you need to perform on your property, plant, and equipment because you own it and you use it. And those types of costs do not meet the recognition criteria because the actual cost doesn't bring a flow to the entity and therefore should be taken into profit or loss. And paragraph 12 then elaborates on that. Paragraph 13 indicates that sometimes we have to replace a part. So when we ended off with the last chapter, we did indicate that our cost would be divided into major components. So if we had to replace a major component, so like for instance, in a vehicle, your engine is a major component. So if you had to replace that engine, then what you would need to do is remove the old carrying amount of that engine, which is the derecognition of the old carrying amount, and we will discuss derecognition as well in a later part. And then once that has been taken out, you will then recognize the cost of the new part as your component cost, because you have finished using the old part and you are now putting a new part in. Yeah, so with respect to subsequent expenditure, we have an illustrative example that we can have a look at, and this example is on page 18 of your prescribed text, illustrative example 5.7. Yeah, so illustrative example 5.7 has a look at the concepts of subsequent expenditure. So we have three companies, company A, B, and C. A is a VAT vendor. They've purchased a building that was in a state of disrepair for 5 million. The building was acquired to house the company's administrative headquarters, and they're estimating they're going to spend another 1.5 million to restore the building to its true potential. Company B is not a VAT vendor, and they've purchased a plant at 116,280. And then company C is a VAT vendor. They paid 4,560 for a furnace that they intend keeping until it's obsolete, which is another 4 years. And within that furnace, there's a lining, which is 25% of the total cost. And it's anticipated that that furnace would need to be replaced on the 1st of January 20.3. And it is accounted for as a separate component. Okay, we can see that the entire furnace has got a 4-year useful life. When we have looked at the date at what this furnace lining needs to be replaced, it says the 1st of January 20.3, and we are in 20.1. So that indicates that that furnace lining only has a useful life of 2 years, which is also very different to the 4-year. And so with that information, you would also be able to make the conclusion that you would have to account for it as a separate component. So you wouldn't need to be told that it would be accounted for as a separate component. Okay, there's some assumptions that have been given to you in terms of the transactions. All transactions were with registered VAT vendors. Our VAT in this case is 14%. Okay, and all the prices are stated inclusive of VAT. So what happened with regards to these three companies? They've each got different assets. So the one is a building, the other is a plant, and the other is a furnace. And what happened with regards to those assets? So in July 20.2, so this was after having acquired it, we've acquired it in 20.1. So this has happened afterwards. So we know that it is subsequent expenditure. Okay, company A paid 1710 with respect to restoration of the building. Company B paid 2,280 with respect to maintenance on their plant, and 11,400 on a new computer, and that is estimated to have the same useful life as the plant, and so therefore they have not accounted for it as a separate component, and they did not previously anticipate to have to replace it. The new card has substantially increased the quality of the plant's output and greatly reduced the plant's reject rate, thus substantially reducing the cost per unit. So this information shows that by spending that 11,400, we are getting greater inputs. So showing us that the recognition criteria is met. The new card had no effect on the plant's capacity. Okay, then with respect to company C, they paid 1710 for a new lining to the furnace. Okay, we did indicate that the furnace was going to be a separate component. The replacement lining embodies new technology that will extend the useful life of the furnace as a whole without any further replacement of the lining by an additional 2 years. And the replacement was undertaken prematurely because of convenience. 200,000 was paid with respect to routine maintenance. Okay, so with respect to these examples, okay, we can see, looking a little bit at the top here, we've got 3 companies with 3 different assets. Then we have those 3 companies then doing some subsequent expenditure on these assets. Some of it is able to be capitalized, such as our restoration, our new computer parts, and our furnace lining replacement. And some of it has to be expensed because it is day-to-day servicing and maintenance. So our maintenance for our plant and our maintenance for our furnace. Yeah, so if we go down and have a look at the solution, we can see in terms of the solution, they want to have a look to see what can be capitalized. So we can see the maintenance was not capitalized at all because it is expensed. Whereas our building restoration and our furnace lining was capitalized, as well as our computer card, with respect to that cost principle that we learned in our last video, where the cost is equal to the purchase price, and we have netted out our VAT because of the fact that some instances we are going to be refunded that VAT because we're a VAT vendor. And so that's how these figures were then taken into account. So the principle is understanding, do I capitalize it? And if I capitalize it, then I need to go and follow that cost principle that we learned in the previous recording. And so once we know that we have to capitalize that subsequent expenditure, it will form part of our cost. And then we would then also have to apply the subsequent measurement criteria to that subsequent expenditure. So in other words, that subsequent expenditure will also be subject to our depreciation, whether we're on the cost or revaluation model, as well as impairments. Okay, so in terms of our measurements, we've already covered that we have 2 models that we can decide upon. We can either use the cost model, or we can use the revaluation model, and these two are specified under paragraph 29. And when we choose this classification, we need to apply it to the entire class of property, plants, and equipment. And so what that means is that if we've got land and we choose to use the revaluation model on land, all land that we own has to be valued according to the revaluation model. We cannot say, well, I've got a piece of land that is sitting in Pietermaritzburg, and because of the area that it's in, it's depreciating. And then I've got a piece of land that's sitting in Umhlanga area, and because of where it is worth a lot more. So I'm going to apply the revaluation model to my Umhlanga lot, but not to my Pietermaritzburg lot. Okay, that is not acceptable according to the measurement criteria. The measurement criteria indicate that it needs to be applied to the entire class of property, plant, and equipment. So that means all land. And then all land would then be applied on the revaluation model, and all land will be on the cost model if we choose the cost model. Okay, so our cost model, then we would measure initially our item at cost, and then we would have our depreciation that would get processed annually. All of our depreciation that has been processed on a particular item added together over the years is our accumulated depreciation. And then we will also apply impairments, which we will cover a little bit later, and we will have a separate session on impairments in week 5. And that accumulated impairment will also be deducted. So in terms of our carrying amount, how we will arrive at our carrying amount is that we will have the cost as per our initial cost, less any accumulated depreciation. So that's all the depreciation that we've processed on the item to date, less any accumulated impairment losses, which is all the impairment that has been processed on the item to date. In contrast, the revaluation model, carries items at fair value, less any subsequent accumulated depreciation, and less any accumulated impairment losses. Okay, with regards to the revaluation model, however, for the purposes of our syllabus, we'll only need to be able to perform and understand the revaluation model for a non-depreciable asset. All depreciable assets are going to be excluded. So in particular, an item of land that doesn't depreciate, that you could be examined on the revaluation model with. Okay, so therefore, from that principle, because we are not taking into account our depreciable assets, then there would not be accumulated depreciation because they're not depreciable assets, but there might be some impairment losses. Okay, so that means that we would then carry our land at our fair value, less any impairment losses from before. In terms of the revaluation model, there is more things that need to be taken into account because of the fact that it's carried at fair value and our initial measurement is at cost. That means the fair value needs to be determined, and that fair value needs to be determined with sufficient regularity according to the standard. So what is meant by sufficient regularity is up for debate. That is something that is a professional decision. So for instance, there might be a piece of land, and that land, because of its location, the value of it does not vary significantly from year to year. And therefore, when you are looking at your revaluation, you would say for that particular item, it is every 3 years. But there might be another type of item, so not land in particular, but another type of item where the fluctuation is a lot more. And so the sufficient regularity, in your professional opinion, has been determined to be maybe 2 years instead. Okay, very importantly, the entire class must be valued at the same time. So again, going back to our example where we've got a Pietermaritzburg piece of land and we've got an Umhlanga piece of land. We cannot say that we are only revaluing the Pietermaritzburg piece of land now, and then in a year's time, we'll look at the Umhlanga one. Because they're in the same class, they both apply the revaluation model. That is what we've chosen for them. And they both need to be valued at the same time. So in January, you perform that valuation. And so therefore, the sufficient regularity clause would be per class of asset as opposed to per individual asset. Okay, in terms of our revaluation, because sometimes a revaluation means that we are going above the cost, okay, an increase above cost then would be recognized in our other comprehensive income. So go back to your week 1 when you looked at presentation of financial statements. In week 1, that presentation of financial statements, you had 2 sections to your statement of profit or loss and other comprehensive income, which is the profit or loss section, and then the other comprehensive income at the bottom. So the revaluation increase is recognized in other comprehensive income, and then it gets accumulated in an equity account, so that will affect your statement of changes in equity as a revaluation surplus, unless it is reversing something that has been recognized in our profit or loss section already, and then you would put it in profit or loss. And we'll have a look at a diagram just now to help put this into perspective. Okay, then the revaluation decrease would normally occur in profit or loss unless we have an existing balance in our revaluation surplus, and then we have to exhaust that first and thereafter continue with the decrease in profit or loss. Okay, so let's put this into a diagram so that it will make a little bit more sense. Okay, so in our diagram, we are going to draw an axis. Okay, so we have an X and a Y axis. This value on the top here represents our cost. Okay, and this entire line here would be representative of where our value is in terms of our land. Okay, this bottom line here is representative of time. Okay, so what happens is, I'm going to use a different color for the line. So let's use some orange. When we purchase our item, we apply what we had done in the first part, and we recognize it as cost. Okay, so on the purchase date, which is the beginning of our timeline, over time, this item will remain at cost. The reason it remains at cost is because it is land, it is a non-depreciable asset. Okay, so let's remind ourselves. So we've got land, there's no depreciation. Okay, what happens along the way is that over time, we've then selected the revaluation model. We go out and we have a look at what the value of our item is. And let's say it's now increased to this point up here. So we would do an increase in value from our cost up to our fair value. And then it will remain at that cost over some time. And then what happens? After our sufficient regularity amount of time has gone, we go and check what the fair value is again. And let's just say now it has all of a sudden dropped. So now it's down here. It's gone below our cost. So in terms of our value, we would now be sitting at that value. And that value will be maintained over our sufficient regularity of time. Okay, so we can see that we have upward and downward movements. The fair value can be above cost and it can be below cost. So for this reason, what we need to do, and I'm going to do this in a different color. I'm going to use a green color, is that we need to understand where our cost is. Okay, and this is our cost line. Okay, so over time, that is our cost line, and we refer to that as our historical carrying amount, HCA, historical carrying amount, or historical cost, because our carrying amount and our cost is the same for a non-depreciable asset. And that line is how we can then go through and decide whether we are going through other comprehensive income in terms of our adjustment, or whether we're going to go through profit or loss. Okay, so everything above the line here will be our OCR. If we go back to the description in the slide, it said an increase in value would be in OCR. Okay, the bottom part here goes through profit or loss. That second part said a decrease would go through profit and loss, except to the extent that we already have an other comprehensive income balance, so a revaluation surplus balance, and then that will be exhausted first. So our first step is to exhaust. Our second step is to go through into profit or loss. Then let's just say that we have another increase in value. On this day, let's just say it goes back to there after the regularity of time. We can then see when we go through is that our increase is in profit or loss to the extent that we've already recognized a decrease in profit or loss. The increase will now be in profit or loss, and then the remainder will go through other comprehensive income. Okay, so if we go back to our slide, so I'm going to stop sharing our whiteboard, and I'm going to share our slides again. These 2 points over here, in terms of the revaluation increase being in OCR, unless it's reversing a decrease that was already in profit or loss, as well as the decrease being recognized in profit or loss, unless we already have a revaluation surplus, and then we're going to decrease OCR and then profit or loss, was depicted through that whiteboard diagram. Yeah, so essentially that is the difference between our cost model and our revaluation model. Okay, so we're going to focus on our depreciation and our accumulated impairments, and what we mean by the depreciation and impairments with regards to the cost model It can apply to the revaluation model, but as I've already specified, for purposes of this course, we're only going to be looking at the non-depreciable assets, and therefore the extent to which we have covered revaluation through that diagram is the extent to which you will be tested on the revaluation model. Okay, something to bear in mind is that there are deferred tax consequences on these adjustments, and deferred tax will be covered in week 3, but it's something for you to think about and to also reflect on your studies from second year, is that when there is a revaluation, there will be a temporary difference, and so there will be a deferred tax adjustment. However, because the item is land, it will be as though that land is going to be sold, and when we sell something that is at a higher value than the cost, we have capital gains effects, and those capital gains effects will therefore be taken into account when we value our deferred tax. Yeah, so it's not too much of an issue at the present moment if you're not understanding the details that's on this slide, because we will go through this in more detail under deferred tax, which is week 3. However, it's something to bear in mind from the point of view in terms of the fact that our topics are all integrated, that if we get asked a question on property, plant, and equipment, having covered our deferred tax, we then need to merge the two together and ensure that we apply the deferred tax part to it as well, unless a question tells us to ignore the taxation effects. So this slide is very important to note, but there will be more information in week 3 that will be taken into account. Okay, so moving into our depreciation. As a third year scholar, you should be very familiar with the principle of depreciation. You should be able to calculate depreciation based on all modes. So for purposes of this section, if you are familiar with depreciation, then perhaps you not need to go through it in as much detail as what the section will cover. However, the more detail is going to be shared for those that are not quite at the level that they should be with regards to depreciation. So ideally, as a third year student, you shouldn't need to be re-lectured on depreciation. You should understand all the principles, but as a pre-lecture, this will be included so that you have the understanding. And so depreciation, the definition of depreciation is covered in paragraph 6 of IAS 16. And that is that depreciation is a systematic allocation of the depreciable amount over useful life. So in other words, we need to know what the useful life of the asset is, and we need to know what is meant by a depreciable amount so that we can allocate a certain amount to depreciation over this period and then fully depreciated by the end of its useful life. And the definition of the depreciable amount is the cost, which we've defined already in our previous session, less the residual value. So then we need to know what is a residual value, because we know what cost is. We've already defined that. We need to now know how do we arrive at residual value. And the residual value, the definition is that it is the estimated amount that an entity would currently obtain. In other words, they will obtain today from the disposal of the assets after deducting costs of disposal, if it were already of the age and condition expected at the end of its useful life. Okay, so this is where students do battle, because sometimes what happens is we get told, if I were to sell my item today, I would get 10,000 Rand. That is not the residual value, because yes, I'm currently obtaining that value, but it's me selling the asset in its condition today, not taking into account what condition it should be in at the end of its useful life. Okay, so in other words, if my useful life is 5 years, my residual is going to be what I can obtain today if that asset was already 5 years old and in the condition I expect it to be in at 5 years old. So perhaps it's got a little bit of scratches on if it's a vehicle. Perhaps there might be some dents here and there, yeah, depending on how we expect our vehicle to have been treated over the 5 years. Perhaps the engine might be a little bit more worn. So because it's been traveling for 5 years and it's done all those kilometers that we've expected to have done, that's what we need to take into account when we look at the residual value. Okay, then the definition of the useful life, that is the period over which we expect to have this asset available for use. That is if we are using the period of time, so number of years. Alternatively, we can use units of production. And units of production is then how much do we anticipate to use this item in terms of production. So example, if we've got a vehicle, we anticipate we're going to use it for 100,000 kilometers. My useful life would then be the 100,000 kilometers. Okay, not the number of years I expect that 100,000 kilometers to be done in, but the actual 100,000 kilometers. So it will be taken into account based on the kilometers traveled as opposed to the actual time frame that it is in my use form. And very importantly, it is entity specific. So I can purchase a vehicle and that vehicle can last me for 20 years. But if as an entity, I'm only anticipating to use it for 3 years because my policy is to replace vehicles after every 3 years, my useful life is the 3 years. So it is based on the entity specific needs. Okay, we've already covered that we need to do each part of property, plant, and equipment. We need to depreciate it according to its components. That is covered through paragraph 43. In terms of our depreciation, when we process our depreciation, we will be debiting an expense. That is the general approach, which goes through profit or loss. However, sometimes we use an asset for production of something else. So if we're using it in production of another asset, then our depreciation becomes a cost of that asset. So for instance, if we have got a plant that is manufacturing inventory, that depreciation will go into the cost of the inventory item as part of an overhead. Yeah, we need to do it in a systematic basis. Yeah, we've already covered that through the definition of what depreciation is. So it's the systematic allocation of our depreciable amount. Very importantly, we need to review all these variables annually. So our residual value and our useful life need to be reviewed at the end of each financial year. And if we find that they need to change for whatever reason, so because expectations have changed, let's say, for instance, we always had the policy that we were going to replace our vehicles after 3 years. Come the end of, or close to the end of maybe the second year, we decide, well, we're going to have to revise that policy because we don't have the capacity to go and replace everything after 3 years. We then will then revise that useful life and say, well, we're going to replace everything after every 5 years. And we will then perform a change in estimate. And the next important part is, when do we begin actually doing the depreciation? So when are we actually going to start calculating this depreciation? And that is when the item is available for use. And that means it must be in that location and condition that is capable of operating in the manner intended by management. So linked to when we stop capitalizing our costs, then after we stop capitalizing our costs, we need to begin our depreciation, and we will stop depreciating either when it's derecognized completely, or if we end up classifying it as held for sale, and we will be covering non-current assets held for sale in week 6 of our course this year, where we will discuss the principles of what happens when an asset is then classified as held for sale. Okay, what factors do we consider? The standard does give us factors to what to consider if we are looking practically at trying to determine what the useful life is. So that's the expected usage of the asset, what the wear and tear is going to be like in terms of the obsolescence. So we could expect that we're going to use it for the next 20 years because that's its capacity. However, because of technological advances, we're probably only going to use it for 5 years. Then we would take the 5 years into account. And the same for our legal limits. Okay, any type of limits that will limit the use of the item, we will then take into account when determining this useful life. Okay, and importantly, land and buildings are to be accounted for separately, even if they're acquired together. So if you purchase a house that's on a stand of land, you pay one amount for that property. However, the land is a separate component and the buildings are a separate component. So they would need to be accounted for separately. And this is clarified in paragraph 58 of IAS 16. And then with our depreciation, we also need a method. So we've got the useful life. We've found out what the residual value is. We now need to know how we are going to allocate it. How are we going to allocate that depreciable amount over the useful life? And this is referred to as the depreciation method, okay, which will reflect the pattern of consumption of benefits. And that too needs to be reviewed at least every year and be accounted for in accordance with IAS 8 if there is any change. Okay, so the illustrative examples in terms of our depreciation are 5.8 through to 5.10. Okay, I will go and have a look at these for purpose of completeness. However, as indicated, this depreciation part should be quite solidified already through your first and second year studies. And so at third year level, it would be assumed that you can very easily apply the depreciation principles and be able to explain the principles and how they are applied. Okay, so example 5.8, we're looking at the depreciation method. And we have 2 different policies in which the company has decided to take into account on its plants. So the old policy was to replace every 3 years. Doesn't matter about the condition, what it's produced. Every 3 years, we're going to replace this plant. Whereas the new policy then takes into production and says that we'll do it over 120,000 units. So that means that if we produce 120,000 units in the first 6 months, we're going to replace the plant. Okay, so based on consumption or based on time. Okay, so The required is to describe the method of depreciation. Okay, so the fact that we're using years versus production. And the second part is to describe how the change in depreciation would be accounted for. Yeah, so if we move down, the old policy was that we replaced it every 3 years. So this was based on years. So therefore we could use a straight line method because we're using it for 3 years and that reflects the time pattern. But the new policy is based on the units of output. And so therefore it would be taken into account based on the number of units produced in the period. Okay, which is the units of production method. Okay, either way, the change in depreciation will be accounted for in accordance with IAS 8 because it's a change in estimates. So we've got the change in accounting estimates. You do have the background to how that change in estimates is calculated. So you would then have to estimate how many units have been produced over the time period that this plant has already been used, and then change your estimation. Okay, our second example has a look at the review of useful life. Okay, so we had a plant that cost 1 million. They depreciate on the straight line method to a nil residual value. So we have got our depreciable amount. Due to previously unforeseen technology advancements, the company revised the expected useful life from 10 years to 7 years. Okay, so that's our total useful life. How would we then change how we are recognizing our depreciation? Okay, so we purchased our item on the 1st of January 20.1. Our dates are very, very vitally important when it comes to depreciation. And we are now looking on the 31st of December 20.3. That is our financial year end. So before the beginning of 20.3, we had used this item for 2 years, which would be 2021 and 2022. Okay, so 20.1 and 20.2 are our 2 years. Okay, so we would have done the depreciation based on the 1 million. So we would have taken the 1 million divided by the 10, and we have taken it into account at 2 years. So that means we've processed 200,000 depreciation over the 2 years. And so my carrying amount is now sitting at 800. At the point where my carrying amount is sitting at 800, then I revised my total useful life to 7 years. Very important. That 7 years is not my remaining useful life from today. It is my total useful life. So I need to say 7 years minus the 2 I've already used it for gives me my 5, and that is my remaining useful life. So my carrying amount divided by my remaining useful life will then give me my depreciation for the year. So it's very important to be able to make that distinguish between, is it the total useful life or is it now the remaining useful life that has been given to me? Okay, so that's 5.8 and 5.9. And looking at an illustrative example 5.10, we have a review of the residual value. So we have acquired an oil tanker at a cost of 1,000 million. Then they anticipated to have a useful life of 10 years using a straight line method, and they estimate its residual value annually. And here's the information with regards to the residual value. So because of inflation, the residual value has changed from year to year. So we can see that it was 500 million, and then it's changed over the years. And then by the end of 2010, it was 830 million. So then what would happen in terms of our calculation is we would still be applying the same principle, okay, which is to take our depreciable amount, which is our cost, the 1,000 million, minus the residual value, okay, which is our depreciable amount, and we're going to divide it by our useful life. Okay, that's easy enough to do in the first year. If we are wanting to then do it from year 2 onwards, the other approach could be that we take our cost minus our accumulated depreciation, because then we've got our carrying amount, minus the residual value. So we know what portion of our carrying amount can be depreciated, and we're going to divide that by our remaining useful life. Okay, so when we have a look at the solution, as we go to the next page, we can see that what they have done is they've used the second approach, which is they've got the carrying amount minus the residual value over the remaining useful life. Okay, and in some years we found that there wasn't some depreciation. Okay, and that is because our carrying amount was lower than our residual value. And in other years, then we actually have our depreciation that has been taken into account. Okay, please note that although this 1 million here is not in brackets, you can see that it has been subtracted. So you may add in the fact that you should have brackets behind that. Okay, depreciation is deducted every year. And so that's how you would be taking into account that change in residual value. Now, the physical calculations of depreciation can be practiced in just about any property, plants, and equipment question, because inevitably, if you have a cost model, you will be depreciating your item over its useful life. So you'd be able to practice that principle of depreciation in any property, plants, and equipment example that you're exposed to. The next part of subsequent measurement that we need to consider is our impairments. Yeah, whilst we're going to be giving a brief summary of impairments, because of the fact that you have covered some indications of impairments in second year, there will be a full portion of impairment covered in week 5 as well. So at this point, we'll cover a summary of what you should already know about impairments and that you would be able to apply at this point. And then we would go through the more stringent criteria of impairment and the actual standards when we cover the impairment standard in week 5. Okay, so impairments although it's referred to in property, plant, and equipment, has its own standard, which is IAS 36. And in summary, every single asset needs to be assessed at the end of its reporting period. So every single property, plant, and equipment asset must be assessed at the end of each reporting period to see if there is any indication of impairment. So we're looking to see, has this item perhaps been damaged? Are there any factors that could indicate that this particular item of property, plant, and equipment is needing to be written down? If we find any indication, that's when we're going to estimate the recoverable amount. When we estimate the recoverable amount, which is defined as the lower, which is defined as the higher of your fair value less cost to sell and your value in use. So once you've estimated those two and you've got a recoverable amount, you will then compare it to your carrying amount. And if your carrying amount is higher than your recoverable amount, then you need to impair. Okay, the slide has it in the opposite direction, that if the recoverable amount is lower than your carrying amount, impair. So that implies that your carrying amount was higher than your recoverable amount. So you can see it in either direction. Once we have impaired, if there are circumstances and or events that lead to provide that this impairment no longer exists, and there is evidence that this impairment no longer exists and will not continue to exist, then the reversal of impairment may take place. So effectively, if the circumstances are no longer there, our recoverable amount would probably have increased. And so therefore, we are going to then be able to reverse that original impairment that had been taken into account. Okay, in terms of impairment often happens when something gets damaged. And if we have an insurance, then we could get paid out for that damage. So we could receive compensation because of the fact that our item is impaired. So when you receive this, you need to please include it in profit or loss. It's not part of the actual property, plant, and equipment side. It is separate. And you need to then do 4 separate economic events. So the fact that you're getting compensated for impairment, first of all, means that your asset was impaired. So the first step is that you are going to impair that asset. You're going to process impairments. Take it down to its recoverable amount. If it is with regards to a complete asset and we no longer have that asset, so like for instance, your vehicle was written off completely, then you can de-recognize the item. Okay, we'll cover de-recognition in the next part of our feature. Then you recognize the compensation from the third party, the proceeds from the third party coming into income. And after that, you would purchase or restore the items with that money, and that would then be capitalized as a new asset. So in substance, we have 4 events. Although it seems like it's one event, I crashed my car, therefore I'm getting paid out from insurance and going to go and buy another car. It is 4 separate economic events. Number 1, I crashed my car, so I am impairing it. Number 2, I cannot use that vehicle anymore. It is no longer going to be mine. It's going to be scrapped, so I need to de-recognize it. Number 3, I've now received my compensation from my insurance company. Number 4, I've taken that money out of my bank now that I received, and I've gone to go and buy a brand new vehicle. So I can now capitalize my new vehicle. And this is then indicated in our illustrative example 5.14, which is on page 31 to 32. Okay, so 5.14, go back to our highlighter. We have a plant that was worth 10 million. It originally cost 20 million. It was impaired to a scrap value of 1 million because of vandalism. So it went down from 10 to 1. The company's insurance settled and gave a 40 million check. Then the company used 20 million to restore the plant. Okay, so in terms of the journal entries, we're going to see that we have 4 separate events. So if we go down, we can see, first of all, we impair. So our assets, it was 10. Its recoverable amount was 1. We need to impair it down to 9. We then, this particular item was not completely needing to be derecognized because of the fact that it was still sitting there. So we didn't have to do a derecognition, but we would do a derecognition in between this if we needed to derecognize it completely. We then got the insurance proceeds. Okay, so we're debiting bank and crediting a profit or loss account. And then we capitalize our costs. So we can see we have debited bank. We have spent 20 million on this particular item. Okay, one of the last things with regards to our subsequent measurements is we need to recall back to when we did our initial measurements and we measured cost, that we said part of the cost of the item would include if we need to decommission the asset, so we need to take it down and restore the environment. So that is referred to as our decommissioning. And we had to include this initial cost in our cost of assets, okay, according to paragraph 16, which we covered in our last session. Subsequent with regards to this particular part of the cost is that you have to remember that this was estimated. Okay, so you estimate that your decommissioning cost will be 5 million. When it comes to the next year, because of price fluctuations, unexpected costs, etc., you are now estimating that it's going to now cost you, let's say, 7 million. Okay, so that change in decommissioning estimate needs to be taken into account as a change in estimate as well. Okay, so in terms of how we're going to account for it, we're only going to have to worry about looking at the cost model, because remember, the revaluation model is only with respect to our non-depreciable assets, which is our land. And that would mean that it's just the land, and you wouldn't have to decommission land. So we're going to focus just on the cost model. Okay, and this change in decommissioning then will be accounted for as follows. So you need to see what the change in the liability would be. And if it is increased, you're going to add it to the cost of the assets. And if it's decreased, you're going to deduct it. If there is a decrease and you need to deduct it, but this item is already depreciated, then any excess of that amount needs to then just go straight to profit or loss. Another aspect is the fact that this cost has changed. That could be an indication of impairment. And so we therefore also need to consider the IAS 36, whether it's an indication of impairment and whether this item is impaired. So with regards to our example, we have an illustrative example, 5.15, that shows how we're going to account for this change. Okay, but the principle is that if we are increasing our decommissioning liability, then we need to credit the liability and debit the cost. If we are decreasing it, we will debit the liability and we will credit the cost to the extent that we actually have a carrying amount to be able to credit it against. Otherwise, we will credit a profit or loss account. Yeah, so let's switch over to our illustrative example, page 15, page 33 to 35, it's 5.15. Okay, so in terms of our illustrative example, we have a coal power plant and a related decommissioning liability. The cost of the plant was 120 million. That included decommissioning of 10. And that was present value of 70 million. That will be payable in 40 years' time, adjusted for risk. So when we've calculated the estimated costs, we've said, well, what will we pay in the future? What is its present value today? Okay, which is then going to be adjusted according to your risk rate of 5%. Yeah, the plant started operating on the 1st of January 20.0. It has a 40-year useful life. Okay, so 1 January. On the 31st of December 20.3, so we have now used it for the whole of 20.0, the whole of 20.1, 20.2, and 20.3. So we've used it for 4 years already. The entity estimated that the net present value of decommissioning liability had decreased by 5 million as a result of technological changes. Okay, and they still applied the same risk-adjusted rate. Okay, so we had originally taken into account at 10 million, but now it should be 5 million. So we needed to prepare the journal entries for all the years up until the end of 2024 with respect to the plants. Okay, so let's go through to the solution. We can see that we recognize the plant at its cost. That was made up by the fact that we paid for the plant, but that we also had a decommissioning liability. So that was our principle that we learned from our last phase in terms of determining cost. We then depreciated this item over straight line. So we've processed 3,000 depreciation. And remember, this decommissioning liability, we need to unwind the discount on, or the discount that we've provided at 5%, so that by the time we get to the time we need to decommission, this value of 10 would have grown to the actual expected value of what we're going to be paying. Okay, which if we go back was going to be that's 70.4 million. In 40 years, it would go up to 70.4 million. Okay, this would have happened in every single year until the fact that we realized, oh wait, the decommissioning liability has now been adjusted to 5 million. Okay, so we would have continued to depreciate our item, but we can see our interest expense has changed because of the fact that we have got a higher liability it's gone up. Then we are adjusting our plant's value and our decommissioning liability. And then the next year we can see now our depreciation changes because our cost here has been modified by the 5,000 over the remaining useful life of 36. So our depreciation has changed because our cost has gone down by that 5,000. Okay, and our interest expense we can also see now is significantly lower because we're working on a present value of 5 now, as opposed to our present value was 10 before. Okay, and then there is our amortization table for our liability. So we started off at 10. We've accounted for interest every year at the 5%. Okay, we've then realized that it needs to be adjusted by the 5. And so the remaining would be the 7,155, and then that would then be multiplied by the 5%. Okay, so that's our amortization table. So the principle coming out of this is to understand that if we have a change in our decommissioning cost, that change needs to be taken into account, not just on the liability side, but we need to have understood that we did originally include it in our cost. So we need to adjust our cost as well. Okay, so that brings us to the end of our part 3. So as a recap of where you should be at now after having followed these videos is that you would understand what is property, plants, and equipment. You'll understand when to recognize it, how much to initially recognize it, and how much then to process in terms of your depreciation, your impairments, and what to do with your subsequent expenditure.